Hello and welcome to Tax Matters and welcome to the month of July. And we must say that the month has begun on a very good note. The long-awaited Petroleum Industry Bill, PIB for short, was passed by both chambers of the National Assembly on Thursday, the 1st of July 2021. The PIB has been in the making for almost 2 decades. Tax Matters is putting together reports on the highlights of the PIB. Watch out! From one good news to another, the Federal Inland Revenue Service has extended filing and payment for year 2021 companies' income tax returns. In a notice that came in on the last day of June, which was supposed to be the deadline, the FIRS announced that it has granted a one-off 1-month extension for the filing of companies' income tax returns by taxpayers with December 31st, 2020 accounting year end, whose statutory tax returns were due by 30th June. The extension is to provide an opportunity for all taxpayers whose company's income tax returns were due in June to file by 31st July, thereby suspending late returns penalty and interest for late filing, provided that the filing process is concluded on the FIRS TaxPro-MAX platform and that the tax due is paid using the payment reference number, PRN, on or before 31st July. And there is a bonus. The extension also provides an opportunity for taxpayers to upload all unused withholding tax credit notes onto the TaxPro-MAX platform not later than 31st July. For inquiries, taxpayers are enjoined to contact the TaxPro-MAX situation room via email on taxpromax.firs.gov.ng. That's a listening organization if you ask me. Now to other business of the day. Today, we want to move on to value-added tax. First, this background. Limited liability companies pay tax on profit, and in Nigeria, it is called companies' income tax. Persons and small and medium-sized enterprises pay tax on income, which, as we told you last episode, can either be through pay-as-you-earn, payee, for salaried workers or direct assessment for small business holders. And still talking about persons, persons also pay taxes on consumption, which is where indirect taxes come in. Major among indirect taxes in Nigeria are value-added tax, electronic money transfer levy, and stamp duties. Value-added tax was introduced into the tax system in Nigeria in 1993, with the law and collection taking effect from January 1994. Value-added tax law is a federal law and collection is solely by the Federal Inland Revenue Service. Sums so collected into the VAT pool account are, however, distributed among the 3 tiers of government. From inception in 1994 to February of the year 2020, the rate of VAT in Nigeria was 5%. With effect from February 2020, the rate became 7.5% by virtue of the Finance Act 2019. The Finance Act 2019 was very copious with regard to VAT. In addition to the rate increase, the Finance Act 2019 extended reliefs to the poor by expanding the list of exempted items. Vatable goods, supplies, and services consumed by persons and organizations attract payment at the point of purchase. Purchases made at supermarkets, stores, and such other places will ordinarily be met with a VAT invoice, which will indicate the cost of the goods or services plus VAT. The buyer pays on the spot or at the point of payment for the supply, the good, and the service. When a supplier or seller collects VAT, he or she is required by law to remit the VAT so collected to the Federal Inland Revenue Service. This can be done either by the 21st day of the month following the transaction, or, as is now the case, the VAT is swept automatically into the VAT account domiciled in the Central Bank of Nigeria. These have been made possible by the newly introduced VAT Auto Collect.
I want to assure you that most of our technical partners can remotely connect their equipment with the taxpayers. They don't need to be there physically. Let me give you an example of the expectation that will come your way. We connected a lounge on one of the beaches in Victoria Island. This is a drinking lounge. And this is a lounge that remits to the relevant tax office 300,000 naira a month. And we saw a VAT liability of 150,000 naira in one day. And it was not a holiday, it was not a weekend. So assuming that lounge opens 4 days a week, you can imagine the collection for that week is already over 300,000 naira. We are deploying for now in these areas: maritime, power, that is electricity, entertainment and transport sectors. We are deploying in hotels, restaurants and clubs. We are deploying in branded superstores. These are chains of supermarkets. For example, now, since July last year, we have connected all the 25 stores of ShopRite. If you buy anything from ShopRite now, you will notice a QR code, and you notice that there is FIRS in it. We have standard restaurants and eateries, telecommunications. We have 4 big companies, and they contribute disparately. But we have over 200 companies in communications. We have MOU with MCC. Once MCC gets, they are automating. So once they get it right, we communicate with them from one point, and whatever comes to any of your offices will be there.
And now, business owners have the opportunity to file and remit VAT via the TaxPro-MAX. To file value-added tax returns, the taxpayer is required to first log on to www.taxpromax.firs.gov.ng and then click on Login as displayed on the screen. The next step is to fill in email address and password and then click on Login. When you log in, the system takes you to the next page, which will display different tasks the taxpayer may wish to perform on the home page. From the dashboard, click on Taxes Due, which will display the different tax types the taxpayer needs to file and/or pay. When the taxpayer clicks on the tax type under the Taxes Due, in this case the VAT, it displays list of tables, and under the action column, click on Process and it will take you to the schedules. The system will display list of schedules on a page with status marked S or ticked if completely filled. Then click on the schedule marked S to proceed and fill in the necessary information. When the taxpayer has filled the necessary information, the next step is to click on Submit, and that's all. You see, it's now as easy as ABC to comply with your tax obligations.
Do you provide goods and services? Then you must answer these important questions. Are you registered for VAT? Do you charge VAT on the goods and services you provide? Do you keep records of all your transactions? Do you file VAT returns? Do you remit VAT collected to government coffers? If your answer to any of these questions is no, then you are breaking the law. The law demands total compliance. Therefore, you must register for VAT. You must charge VAT on goods and services. You must file VAT returns. And you must remit all VAT collected on behalf of government within 21 days to the bank nearest to you. To do otherwise is a crime punishable everywhere in the world. VAT is prescribed by the law. Do the right thing. Collect and pay VAT. This message is from the FIRS. It pays to pay your tax.
Thank you for staying with us. We are now in the second half of the year 2021. The Finance Act 2020, yes, Finance Act 2020, that is what the legislators in their wisdom have decided to name it. The Finance Act 2020, which took effect from January 1st, 2021, is the one that is guiding tax administration in this year 2021. Now, the Finance Act 2020 is 6 months old already, and we feel that it is a good idea to bring it back onto the front burner to assess how it has affected tax administration in the current year. Barrister Chukwuka Ikwazum, a senior advocate of Nigeria, spoke at a recent retreat and had the task of dissecting the Finance Act 2020. In doing so, he, as you will find presently, had to look at the Finance Act 2019 and that of 2020 together.
I think that for proper context, it is important that we understand some of the factors that drove a lot of the changes that we see in the Finance Act. Before the enactment of the 2020 Finance Act, the National Assembly had enacted the Finance Act of 2019. Now, when you look at those two pieces of legislation, what you see is an attempt to resolve a lot of the disputations that had occurred as between taxpayers and the tax authorities over the years leading to the passage of those acts. So, for example, if you look at the 2019 Finance Act, you see that one of the issues that that act dealt with was the controversy surrounding Section 19 of the Companies Income Tax Act, the so-called excess dividend tax. I know at least 6 different lawsuits at different times that went from the Tax Appeal Tribunal through the Federal High Court, even to the Court of Appeal on that issue. And that issue was essentially, what is the proper interpretation of that provision? So, for example, taxpayers complained that that provision should not apply to what we call franked investment income, which under the Companies Income Tax Act is declared to be exempt from further tax. If you look at the 2019 Finance Act, you see that there was an attempt, a very robust attempt, to resolve that controversy. Take another example, Section 10 of the VAT Act. I'm sure many of us here are familiar with the cases of Vodacom and FIRS, Gazprom. Now, both the Gazprom case and the Vodacom case have gone on appeal to the Federal High Court and the Vodacom to the Court of Appeal. And the Court of Appeal has confirmed the position of the tax authority. Now, if you look at the Finance Act of 2020, you will also see that there was a clear attempt to resolve issues, the issues that gave rise to that controversy. You can say the same thing about what is the correct interpretation of public character for the purposes of the exemption granted under Section 23 of the Companies Income Tax Act.
In this regard, Barrister Ikwazum gave the example of a case between the FIRS and a private educational institution before the TAT.
The Federal Inland Revenue Service had taken the position that because the American International School is a very expensive school, and because it is expensive, not many Nigerians can afford to send their kids to that school. And as a result of that, the educational activities that the school engaged in were not of a public character. And it was for that reason that, we went before the Tax Appeal Tribunal. And the Tax Appeal Tribunal in Lagos said, look, the test of public character is whether the business formation was registered as a limited liability company or as a company limited by guarantee or incorporated trustees, and whether surpluses are distributed to promoters of the entity. And in the wisdom of the Tax Appeal Tribunal, Lagos, they said that the American International School satisfied those criteria. Now today, the Finance Act of 2020 has now defined public character by reference to those two criteria. So again, you can see that there was a clear attempt by the legislature in the Finance Act to resolve that controversy.
Barrister Ikwazum proceeded to discuss the earth-shaking relief extended to small and medium-sized enterprises in the Finance Act 2019, which continued in the Finance Act 2020.
Section 23 of the Companies Income Tax Act is the section that provides for profits and income that are exempt from tax. Again, before I get to the 2020 Finance Act, it's important for context to understand the changes that the 2019 Finance Act made to Section 23. Now, the first change is that a new paragraph O was introduced. And what that paragraph does is to exempt the profits of small companies from tax. Now, it's important that I mention this. One of the innovations in the 2019 Finance Act is that Nigerian companies are now grouped into three: small companies, medium-sized companies, and large companies. Now, small companies are companies that have turnovers of 25 million naira or less. Medium-sized companies are companies that have 100 million to 25 million, and anything above that, you're a large company. Obviously, responding to the difficulties and challenges of doing business in Nigeria, tax concessions were granted to small and medium-sized companies.
The Finance Act 2020 also brought relief to the real estate sector.
Then, there is the introduction of paragraph S, which exempts from tax the dividend and rental income received by a real estate investment company on behalf of its shareholders, provided that at least 75% of the income is distributed and the distribution is made within 12 months of the end of the financial year in which the dividend or rental income was earned. Now, the question is, what is the philosophy behind this? A real estate company earns income, rental income, dividend income. Now, before that income is earned, there must have been withholding tax applied to that income. So, in the hands of the real estate company, that income is actually, in its true nature, franked investment income, because it is passive income that has been subjected to withholding tax. So it will not make sense to now apply another tax in the hands of the real estate company on that income. But the law says that the only way you can benefit from that exemption is that 75% of that income must be distributed to your shareholders, and the distribution must take place within 12 months.
Under the Finance Act 2020, gratuity, that lump sum that is paid to the retiring worker, is subject to capital gains tax on only sums above 10 million naira, meaning that the first 10 million naira is non-taxable. Therefore, if the retiree is paid 12 million naira, it is 2 million naira that is subject to capital gains tax. We recall that in some of the episodes of Tax Matters aired at the beginning of the year on the provisions of the Finance Act 2020, this matter came up.
Now, another issue for consideration is the definition of compensation for loss of office for the purpose of capital gains tax. Now, the Act provides for exemption of capital gains on compensation or damage for loss of office up to a maximum of 10 million naira and an opposition of CGT on any amount that exceeds 10 million naira. The Act also places an obligation for deducting and remitting CGT on the compensation for loss of office to the payer of such compensation. This amendment seems to have resolved most of the ambiguities with respect to the provisions. However, one critical issue is, what do we even mean by compensation for loss of office? This wasn't defined in the Act. Now, which of the following will be classified as compensation for loss of office? Would it be termination of employment under a restructuring program, outright dismissal, involuntary resignation, gratuity payments? I mean, can we really classify gratuity payments as compensation for loss of office? What about terminal benefit or retirement benefit?
Withholding obligation has been placed on employers when they pay compensation for loss of employment to deduct capital gain tax at 10% if the amount on any amount over 10 million. In other words, if you pay 15 million for someone who has lost their employment, you deduct 10% on the 5 million over and above 10 million.
Let me go very quickly to capital gains tax. Of course, the Finance Act 2020 made a number of amendments to the Capital Gains Tax Act. But the one that I want to focus on is, again, I keep making this remark, evidence of, bringing the law to be in tune with modern realities. If you look at the old CGT Act, you will see that compensation for loss of office, the exemption that was granted, the threshold was a very minimal amount. I can't remember whether it was 10,000 naira or something. And why was that so? The CGT Act was an act that was enacted in the 60s, when 10,000 naira was a lot of money. So the Finance Act has now amended that provision to make the threshold to be 10 million naira. Right? But the controversy, for me, the main controversy with that provision has not been addressed by the Finance Act. And what is that controversy? It is, what does compensation for loss of office mean? What does it mean? Is it when I resign from my employment, or when I'm sacked? The controversy between termination benefits and terminal benefits, that controversy has not been clarified. The Lagos State Internal Revenue Service some time ago issued like an advisory on this issue to draw a distinction between a termination benefit and a terminal benefit. Now, a terminal benefit is, you have been with your company for 30 years. You now decide that you want to retire. Right? And you retire. And when you retire, the payment that is made to you is computed by reference to your conditions of employment. So the Lagos Internal Revenue Service says that payment is a terminal benefit and not a termination benefit. Not exactly. So that what will qualify as loss of office will be a termination benefit as opposed to terminal benefit. I agree with that position, but I think that for clarity, if I had an opportunity to advise the legislature, I would have recommended that that be made very clear in the law.
These things do have effects on the bottom lines of companies and, of course, can throw up compliance issues when tax auditors come calling. There you are. Finance Act 2020 made easy. That is our job on Tax Matters, using enlightenment and education to make it easy for you to comply with your civic obligations as a taxpayer. Let's do this again next week on this same station, same day of the week, same time of the day. Bye for now.